Welcome to Markets Now. I'm Michelle Rook along with Shawn Hackett with Hackett Financial Advisors. A lot of red on the board here today with the exception of some of the cattle contracts. And Shawn, the pressure that we're seeing in the grains, well, it kind of started yesterday already, but some of that is kind of tied to this change in the weather forecast, isn't it?
Yeah, there was a lot of forecast that this colder weather was going to persist into April and cause some delays. And all of a sudden, we've gotten this big warm up in a good swath of the country, drying out. And, with the moisture already in the ground sufficient, it means that the planters are really going to roll pretty fast. And even though the northern plains continue to be a worry area, it's not a big enough area and an important enough area that's going to override the bearishness of getting the core grain belt off to a good start.
Let's talk a little bit more about that because the 92 million acres that are projected to be planted by USDA or intended to be planted, I guess. How tough a lift is that going to be, especially with the northern plains under snowpack and Taka prevent plant? And, what does that mean for prices?
Well, I mean, certainly we're not going to get all the corn acres planted in the northern plains, and we are going to have to dial back those acres a little bit. But then it begs the question, we are already way overproducing based upon the outlook report. If you just go with that kind of demand side that they are expecting, we already were way overproducing. So it still comes down to what kind of yield are we going to have, right, Michelle? I mean, in 2012, we planted a record number of acres and we had the worst crop in 50 years because the yields weren't there. So I don't think on the margin the acres are going to be too different. Maybe it could be a million acres off, but I still think it comes down to if the other areas of the grain belt are off to a good start, they're going to assume big yields overriding lower acres in the northern plains.
And if that's the case, then we could go up to 1.72 billion bushel ending stocks figures. And where does that put December corn then?
Well, certainly, if we're planting 91 million acres, take 10% off on the harvested acres, and we produce a 180, 181 yield, which is, I guess, is where the USDA is on their trend line yields, and we put a 2 billion or 2.5 billion bushel carry out in front of the number, I think you'd have to be looking at $4.50 corn, Michelle. Something in the fours would certainly be an area on the charts that would argue for where the market, would have a strong inclination to be. I mean, already we're at 5.5. It wouldn't be a stretch to think that we could take another dollar off by, harvest pressure season and maybe put that in for the low for some extended period of time. But it would that price would be a hurting price for farmers who still have sticky cost of production, not coming down as fast as prices are.
And that would be that lower number you talk about. We got to hold 525, you said, on the D's chart.
Yes. Yeah, I really think that's the line in the sand, and we think we could come there, maybe in April if we really keep moving those planters and that weather forecast still looks good. I don't think we can really give way to that number until we really are convinced that pollination has gone well and we have that big crop. Lots and lots of weather to come and other factors, but I don't think we can go below that right now. But ultimately, if and when we do, that's your trigger for, a much more protracted move to the downside.
Gotcha. Of course, soybeans are lower as well. And where do you see new crop going there? Because 87.5 million acres doesn't seem like enough acres here with the demand that we have coming at the market.
Well, everyone's trying to determine what is that demand. We know that Brazil had a huge crop overriding the Argentina poor crop. We know that African swine fever is causing significant reductions in the need for bean meal in China, meaning they're not going to need a lot of soybeans for a while. And the EPA is going to make their final determination on how much renewable diesel is going to be mandated to be covered by subsidies. A refiner is not going to operate at a loss. He's going to operate as much as he can while he can make money. And so the numbers they preliminary came out with a few months back, Michelle, were very disappointing. If those numbers stay the same in their final numbers in June, we probably are planting enough soybean acres. If we come in with a much larger number of mandated renewable diesel and the need for bean oil, then those numbers become too low, and that could be the trigger for more of an explosive move to the upside. But obviously, we have a few months before we get to that important number, and of course, weather is also a factor.
Of course, we had nice retracements in both corn and soybeans off the lows here now. And so do you think some of this is just a little profit taking? Did we see a pickup in farmer selling when we got up to these levels as well?
Yeah, I mean, I think farmers, are looking at everything and saying, I have to be careful. If we have the big crop, if we have the much lower prices, if we put on these big ending stocks, I have to make sure I can farm next year, and that means you got to be making sure you have enough sales on the books that you can weather an ugly period later in the year. But of course, you don't want to sell too much. What if we have crop problems coming back? We think we are going to have some crop problems coming back, and you don't want to be overselling either in case we get kind of a rope-a-dope market into June, July. You want to keep some powder dry to make even better sales. But once again, it's a risk-reward factor. And if you're someone that has not gotten a lot of sales on new crop done, you want to be selling rallies here,
Okay.
what I call just in case.
Wheat disappointing yesterday to see a lower close. I know it got dragged down by other markets, but only a 28% good to excellent crop rating on winter wheat. So is the market looking forward here at maybe some improved weather conditions?
Remember, what moves markets and what it does not know. Everyone knows the Southern Plains have been in this terrible drought. Everyone knows it was a terribly rated crop. I don't think anyone was surprised that the ratings were so low. So that's known. But what wasn't known or wasn't known last week was that the weather pattern seems to be pushing rainfall into that driest Southern Plains, Kansas area into the late April. Of course, the weather models can change, but if those rains do verify, it is still not too late to bring some potential yield back on to the balance sheet that the market currently does not have on, and the market's going to trade that, especially in April. We've had a lot of times in the past where April rains, rehabilitate the crop surprisingly strong, and the crop turned out to be, while not great, much better than anticipated. So long as those rains are in the forecast, I think we could see some pressure on the winter wheat market and the wheat market as a whole going into mid-April.
That's also going to weigh on this cotton market, I would assume, in anticipation as well of maybe a rate hike by the Fed here coming up. We also kind of have risk off here that's weighing on that cotton market too, don't we?
For sure. I mean, all this ugly economic numbers we've seen this week showing an accelerating decline in the economy, the Fed saying they're going to continue to raise rates. If we get rains in Texas and in Oklahoma, like especially that western Texas area, guess what? That means that the planters can really get going, finally getting some moisture in areas that they haven't gotten rain in a long time. So there's a lot of reasons to be on guard here for possible further weakness in cotton prices into the late April. It seems like a theme here. I keep saying late April looks like there's more weakness. I kind of feel a lot of ag markets are showing more weakness and commodities as a whole based upon a lot of these different factors before we might see some kind of a spring turn back up.
Okay. And the rate hike that we talked about from the Fed is now being pushed here a little bit by the idea that crude oil is going to be higher with this cut in OPEC production, right?
Yeah, I mean, the market is thinking, well, if that's more of a permanent move higher, that's going to take longer for the inflation numbers to come down. Obviously, until we get that headline number, Michelle, that shows a big knockdown, like 1 month over another, the Fed's going to want to be safer than sorry because it looks so bad not tightening sooner than they did. They're going to keep putting their pedal onto the brakes of tightening, meaning making more tightening versus not. And so we haven't seen that big inflation reduction number yet. And so unfortunately for the markets, it looks like they're going to continue to do this. Now, of course, the bond market has already lowered interest rates a lot. The 10-year, the 30-year, the 5-year, even the 2-year down a lot. The dollar's been very, very weak, suggesting they're anticipating a much slower economy. The precious metals taking off, gold and silver, really moving higher, which are first movers on anticipating longer-term changes in monetary policy. But it looks like the Fed is still sticking with a short-term tightening, and that keeps markets under pressure.
All right. Good discussion this morning. Thanks for joining us. Shawn Hackett with Hackett Financial Advisors, and that is Markets Now.